At 7:42 a.m. London time, in a glass-walled risk pod above the OTC metals desks, the first alert wasn't a price spike. It was a basis print that should not have existed in an orderly market. Spot was quiet, the front month looked normal, yet the physical quote coming back from three different routes, vault to vault, refinery allocation, and immediate export, was higher by a spread that refused to compress, as if the screen price had become a reference instead of a clearing level. The incident frame matters because it's exactly how Bitcoin's 2020 regime shift began, not with headlines, but with a mechanical mismatch between what the market displayed and what the market could actually deliver when size showed up. Back then, it was coins leaving exchanges into cold storage while the chart went sideways. Now it's metal being pulled into private pipelines while futures liquidity keeps smiling. This is bigger than it looks because silver is one of the few assets that lives in two universes at once: an institutional paper lattice built for hedging and leverage, and a physical supply chain constrained by atoms, logistics, and industrial pull. And when those universes start pricing differently, the separation tends to widen before anyone admits it exists. You can see it in the way serious buyers are behaving. They're not negotiating pennies over spot. They're negotiating certainty, delivery windows, assay acceptance, jurisdiction, and whether title is clean before funds move. And you can measure it with anchors that don't care about narrative. A 1.1 ounce is no longer clearing at a 1.1 price, and within the next 72 hours, the market has to reconcile whether silver means a claim on a ledger or a bar that can be loaded, insured, and moved. If you're part of the vault-minded community that watches structure more than headlines, drop your location in the roll call quietly, because this divergence is global, and the pressure points show up first where demand can't wait. The question isn't whether silver is bullish or bearish on a chart. The question is whether the machinery that keeps paper and physical aligned is starting to slip a gear. And the next paragraph is where we trace the exact mechanism that traps the wrong side when that gear slips. The mechanism is mechanical, not mystical, and it starts with a structure almost nobody respects until it begins to bite. Silver trades as a single asset in conversation, but it functions as a stack of claims with a hierarchy, and the spread you're seeing is the market repricing that hierarchy in real time. In the paper universe, futures, swaps, unallocated accounts, ETF shares, silver is primarily a balance sheet instrument. It is easy to create, easy to net, and easy to roll. In the physical universe, good delivery bars, refinery output, bonded inventory, export cleared stock, silver is an industrial feedstock with delivery constraints, financing costs, and jurisdictional friction. When everything is calm, those universes clear at roughly the same number because arbitrage keeps them stapled together. If spot is cheap and physical is dear, someone buys spot exposure and sells physical, or borrows metal, delivers it, and earns the spread. If physical is cheap and paper is dear, someone does the opposite. But the staple is not price. It's confidence in convertibility. The moment the market doubts whether a paper claim can be converted into the exact form of physical demanded, on the schedule demanded, the arbitrage breaks, and instead of one silver price, you get two. A screen price that reflects tradable claims, and a possession price that reflects deliverable reality. That is the Bitcoin 2020 warning. When coins were quietly leaving exchanges into long-term custody, the on-screen market still looked liquid until one day it wasn't. The same sequence in silver is not coins leaving a hot wallet, it's metal leaving the available for prompt delivery stack into private pipelines where it won't come back just because the chart asks politely. Who gets trapped when that staple fails? The trapped parties are not the loud retail speculators. It's the intermediaries who made their business on the assumption that paper and physical can always be reconciled with time. Dealers, banks, and large market makers typically operate short optionality whether they admit it or not. They sell liquidity to everyone else. They quote tight markets, they warehouse exposure, they run basis books, and they assume that if they need metal, they can source it through leases, swaps, EFP, EFR style off-exchange mechanisms, or simple, we'll pay up and someone will sell. That assumption holds until physical holders stop responding to price and start responding to risk. In a tightening regime, the marginal holder is no longer motivated by a few dollars of upside. They are motivated by not being the last person holding a claim when settlement terms change. So, metal becomes sticky. The dealer who counted on being able to borrow bars discovers the lease market is quoting punitive terms or simply stepping aside. The bank that counted on netting flows discovers clients are all leaning the same direction. Everyone wants certainty at once. The refiner that could once promise output within a normal lead time is suddenly booked, not because demand rose gradually, but because strategic buyers pulled future supply forward. And the longer the physical side refuses to respond, the more the paper side has to contort to preserve the appearance of normalcy. This is where the cascade starts to look like unraveling. It begins as a basis problem, spot versus physical, nearby versus deferred. Then it becomes a collateral problem, and then it becomes a governance problem. On the collateral side, the moment silver begins to gap between paper exposure and real delivery, every levered participant is forced to remargin the position not only against price, but against the risk of failing to perform. That matters because in modern markets, the true constraint is not, can you make money? It's, can you fund the position through volatility and deadlines? Funding is the hidden accelerant. If a bank is short silver in paper terms, because it has sold forwards, structured notes, or provided hedges, and it suddenly needs to obtain physical to neutralize delivery exposure, it can't just click buy and be done. It has to locate metal, finance it, transport it, clear it, and document title. Each step consumes balance sheet. As volatility rises, margin requirements can be increased into the move, which forces participants to post more collateral precisely when collateral is hardest to raise. This is the mechanical doom loop. Higher volatility tightens funding. Tighter funding reduces liquidity. Reduced liquidity widens spreads. Wider spreads signal stress. Stress attracts more demand for certainty, and demand for certainty drains the very inventory that would have restored confidence. Nobody has to panic for this to occur. It's simply how levered systems behave when conversion is questioned. Now, the governance layer, this is the part experienced viewers should take seriously because it is where quiet rule change happens without being called that. Every major market has procedures designed to protect clearing and settlement. Those procedures are often written with enough flexibility to preserve continuity during abnormal conditions. That flexibility is a feature until it becomes the price of admission. When deliverable supply is tight and too many participants attempt to move from paper to physical at once, the system has only a limited toolkit. It can incentivize people to roll. It can encourage bilateral settlement off the exchange. It can lengthen timelines through operational explanations, or it can redefine what is treated as equivalent performance. The language is always clean. Orderly markets, efficient settlement, temporary measures, yet the consequence is always the same. The contract's meaning shifts at the margin, and once the margin shifts, behavior shifts. Longs who previously treated paper as a proxy suddenly treat paper as a risk. Shorts who previously treated physical sourcing as routine suddenly treat physical sourcing as an existential constraint. That behavioral shift is the unraveling. The system doesn't break because a headline says it broke. It breaks because participants stop playing the role the system requires them to play. This is also why the Bitcoin comparison isn't about price appreciation. It's about the transition from visible liquidity to hidden scarcity. In Bitcoin's 2020 setup, the critical change was custodial flow. Supply on exchanges fell, while paper representations and derivatives still traded as if supply was abundant. The consequence was delayed price discovery until one day, price had to move violently to find sellers. Silver's equivalent is inventory that stops being available at the margin. It doesn't have to vanish globally, it just has to stop being offered into the delivery-relevant channels. When that happens, the paper market can continue printing liquidity because contracts can be created in seconds, but the physical market begins pricing urgency because production lead times, shipping lanes, and refinery throughput cannot be accelerated with keystrokes. So the spread becomes the signal. It's not an error bar, it's the market admitting, quietly, that time and certainty now cost more than exposure. The trapped actor in this stage is the one who thought optionality was free. If you're short, you assumed you could always buy back or deliver later. If you're long in paper form, you assumed you could always convert when you wanted. If you're a hedger, you assumed your hedge would behave like the underlying asset. But when the physical paper split widens, those assumptions fracture. The short learns that deliver later is not always permitted on someone else's schedule. The long learns that convert is not a right in practice unless you hold the right claim in the right venue with the right settlement language. The hedger learns that a hedge that tracks price but fails to secure supply is not a hedge. It's a chart comfort. And here's the sharp part. The system will attempt to keep the screen calm for as long as possible because calm screens are how confidence is preserved while obligations are negotiated privately. That's why, during the early stages of mechanical unraveling, the most alarming evidence is not a vertical candlestick. It's a stable candlestick alongside worsening terms in the real world, premiums, lead times, and reluctance to quote size. If you want a single structure to hold in your mind, it's this. Silver isn't moving from cheap to expensive first. It's moving from available to allocated. That distinction changes everything because it means the market is no longer debating value, it's debating access. Access is what produces forced participation. Once enough large actors decide they must secure metal, industrial users protecting supply chains, sovereign buyers protecting strategic inputs, funds protecting against monetary instability, then everyone else is drafted into their problem. Dealers must source, banks must fund, shorts must cover or negotiate. Exchanges must preserve settlement, and the people who can't or won't participate on those terms are pushed into the only remaining option: accept paper settlement and hope the spread closes later. The moment that becomes common, the paper price stops being the price and becomes the price of staying in the paper lane. That is exactly when the system's mechanical integrity is questioned by serious money. And once serious money questions integrity, it doesn't shout, it withdraws. In the next paragraph, we'll translate this into household consequences without theatrics. What this means for retirees who care about liquidity and purchasing power, what thresholds to watch within the next 48 hours and into Monday's open, and the specific signals that tell you whether this divergence is a temporary squeeze or the first visible seam of a much larger repricing that the screen will only admit after the physical market has already moved. For a household, especially one that has already lived through multiple once-in-a-lifetime events, the practical issue isn't whether silver becomes a headline trade, it's whether the plumbing that sets prices begins to transmit stress into everyday liquidity. When the physical paper split widens, you often see a quiet tightening first. Brokers raise margin on metals-linked exposure, dealers widen spreads, and the cost of immediacy climbs even if the chart looks tame. The real consequence is that your portfolio can become harder to rebalance at the exact moment you'd want optionality, because the market starts charging for certainty. If you hold silver through paper vehicles, you're exposed to the risk that the instrument tracks the screen price while the real-world replacement cost moves elsewhere. If you hold physical, you're exposed to premiums and lead times that can turn liquid into available later. Neither is inherently wrong, but the difference matters when the system transitions from price discovery to term discovery, and that transition is where retirees get blindsided, not by volatility, but by the realization that liquidity has layers. So what should a smart viewer watch next, specifically within the next 48 hours and into Monday's open? First, watch whether the spread behavior is self-healing or self-reinforcing. If the divergence narrows because physical supply reappears, quotes improve, lead times shrink, premiums soften, then the system is still stapled together and you're looking at a squeeze, not a regime shift. If instead premiums remain stubborn while futures stay orderly, that's the footprint of stress being absorbed off screen. Second, watch the near-month structure. If the front month stays, bid relative to the back months, or if the market pays you unusually well to roll out of immediacy, that's the market pricing time as a scarce resource. Third, watch the language and behavior around settlement. When desks start emphasizing alternatives, cash equivalent, delayed allocation, operational constraints, special bilateral arrangements, that's not commentary, it's triage, and it usually precedes a quiet rule change that is framed as routine. Fourth, watch liquidity at the open. If Monday begins with heavy volume but strangely muted directional follow-through, it can indicate that the market is clearing obligations through negotiated channels rather than repricing in public, which is exactly how mechanical unwinds disguise themselves until they can't. Your choice, then, is not buy or sell as a reflex. It's observe the right signals and refuse to be late to the recognition phase. Bitcoin's 2020 lesson was that the visible breakout came after the invisible accumulation had already tightened supply. Silver's version is that the visible repricing comes after the physical market has already moved to allocation and the paper market has already started offering incentives to keep claims from turning into requests. Over the weekend, pay attention to any sudden improvement or deterioration in real delivery terms, and on Monday, pay attention to whether the market behaves like it's searching for a price or protecting a process, because protection mode is when the rules begin to bend. And here's the unresolved part that matters most. If the staple between paper and physical fails decisively, the first shock may not be a vertical candle at all. It may be a settlement adjustment that looks minor on paper, but forces every serious holder to ask the same question at once. If this claim can't become metal on demand, what exactly am I holding when the next wave hits? And if you're wondering where the trigger hides, it's usually not a dramatic failure. It's a subtle constraint that forces mass behavior. One Monday, a dealer who always quoted size suddenly quotes subject to allocation. One morning, the roll becomes unusually expensive, as if the market is paying you to leave the front month alone. One afternoon, a familiar product quietly changes settlement language in a way most people won't read until it matters. Those are not random frictions. They're the system protecting itself from a demand it can't satisfy without repricing. In practical terms, that means your next best move is to watch for discontinuities. Any day where the chart looks calm but the real-world acquisition channel turns restrictive, any session where liquidity thins and spreads widen without a headline catalyst, any week where delivery becomes a negotiation instead of a function. Experienced capital doesn't wait for confirmation on cable news. It watches whether access is being rationed, because rationing is the market admitting scarcity without letting price admit it first. Here's the final frame to hold as you go into the next week. When silver starts flashing Bitcoin's 2020 warning, the question is no longer how high can it go? It's what breaks first, the spread or the confidence. If the spread snaps shut because paper reprices upward to meet physical, that's an explosive but clean resolution. The chart catches up to reality. If the spread is contained by policy, through incentives, substitutions, delays, or paperwork equivalents, then the price might look managed, but the confidence leak accelerates beneath it, and the real repricing migrates to the venues that still deliver. That's why the most important signal isn't a number. It's whether the market is still willing to offer immediacy at scale without rewriting the meaning of settlement. Watch Monday's first hour for stress in the front month behavior. Watch the next 48 hours for any sign that premiums and lead times are becoming the true price. And watch for the moment the market stops arguing about valuation and starts arguing about performance, because that's when a mechanical unwind becomes a structural one. The unresolved teaser is this. If the machine has already begun to unravel, the next visible move may not be a rally at all. It may be a quiet adjustment that tells you, without saying it, that the paper lane is being separated from the physical lane for good.